Great.
Good morning, everyone. Welcome to today's section. My name is Igwe Ogoro, and I work at Rat5 Tech Hub. Today, we are going to look at financial modeling. And at the end of this section, you will understand how to design your own financial model for your own business. Before we get started, let us understand the concept of financial model. The accounting aspect happens to be the past and historical financial data about your business. But a financial model is a mathematical model of a representation of your future finances. Here, you are making a projection. So for us to understand it, we are going to see the benefits. So one of the benefits is that it minimize risk. So it helps you to determine the cost implication for any project before you commence. So before you get into starting any project, with your financial model, you can clearly understand what the cost implication will be before you jump into executing, so you don't end up losing money. Secondly, it gives you accurate financial budget and forecasts. So it's used for forecasting. So the essence of this is that it helps you to stay within your business structure. So if your financial model say we are going to spend 50,000 naira or dollars, as the case may be, you are going to stick to it because you already have a financial focus. Most people, once they raise fund, you now see them, oh, let's go and buy this. Oh, let's go and buy this. So the focus is what will keep you in alignment with your business structure. Also, it helps in business growth. With your financial model, you can determine and see areas you can make possible investments. You can be able to, it's a mathematical model. So you can see areas that if we invest more money here, we are going to have much revenue. So let's invest there. So it can help you in driving business growth. Also, it helps in business valuation. So how do you understand and determine the worth of your business, the worth of your company? So we have what we call the free cash flow. So it helps you to determine what your free cash flow is, right? And you can also determine, okay, this is the potential worth of this business in the next 4 years, 5 years, because you can see the focus for the next 4 or 5 years. And it can help you to also make some certain decisions to say, oh, we are not selling this company. Why? Because we know that our future, right, is bright. So the financial model is what can help you to see the future. Now, it also helps you to decide the fund requirement or strategy. So how are we going to raise fund? Are we going to raise fund through equity or debt investment, through loans? So you can see that from your financial model, if we raise 1 million naira, our financial model is showing us that we can be able to repay this money with the interest in the next 8 months. So let us go for loan and not go for equity, since we are seeing that we can be able to repay this debt within 8 months and we are not going to give out any equity. So we can also see from our financial model that it's going to take us about 3 years for us to start breaking even or start generating reasonable revenue. So at this point, let us go for equity, right? Because we need patient capital. So lastly, from our point, there are numerous benefits of the financial model. So, but the last on the list here is that it gives you in-depth understanding about your business. So you can clearly understand certain factors that affect your business. You can see some numbers in terms of the cost the cost implication for a particular activity in your business. You cannot see by reducing this cost, this can help you increase your sales. By reducing this can help us do this. By increasing this amount, this will help us do this. So it gives you in-depth knowledge about your business. So this is a practical section. We are going to jump into the practical aspect of it and see how we can design our own financial model. But before we do that, let's look at some key financial metrics. These are some of the things we are going to see while designing our financial model. One is revenue. So almost all of us know what revenue is. So that's the total income generated from your sales or from your service. Okay, so we are going to see things like the gross profit. So revenue minus the cost of goods sold. So there's something called COGS, cost of goods sold. Okay, we are also going to see it why we are working on the financial model. So we also have the gross margin. Okay, so this is a gross profit as of percentage of revenue. We also have the OPEX. OPEX simply means operating expenses. Okay, operating expenses. So we also have what we call the burn rate. The burn rate is the rate at which you spend your capital. The rate at which you spend your cash. Let's take an example. If every month you spend 20,000 naira, what it means is that your burn rate is 20,000. Your monthly burn rate is 20,000, right? Now, the next is runway. Runway is estimated time until you run out of fund. So let's assume that you have 200,000 naira and your burn rate, which is the amount of capital of cash that you spend, is 20,000. So this means that you are going to do 200,000 divide by 20,000. Okay, so this means that you are going to spend this money for the next 10 months, right? So that will give you 10. So your runway happens to be how long it's going to take you until you exhaust that money or fund that you have at hand. So that is your runway. Your churn rate happens to be at what rate? Okay, the rate at which customers stop using your product and service, right? Especially for subscription-based business. So you have 50 customers January. You have 50 customers by January. Every month you have 50 customers. For January 50, for February 50. So the total is going to be 100. So by February, you are expected to have 100 customers. But some persons you acquired by January might say, we are no longer interested in this. So those people that leave or stop using your service, that is your churn rate. So the percentage there could not be that 50% of them will stop using your product. So let's say they are 50, that means 25 of them will stop using your product, meaning that you have 50% churn rate, meaning 50% drop off from people who stop using your service. Okay, now we have what we call CAC. So here we are not talking about corporate affairs commission. So we are talking about customer acquisition cost. So this is what it costs you to acquire a customer, right? So you need to know all these numbers. So you also need to understand your operating income. We are going to see all these while we are building our financial model, okay? So we are going to see the operating income, which is your revenue minus the operating expense. We are also going to see the operating margin. That is the percentage aspect of the operating income. We are also going to see the net income, okay, which is your total revenue minus all expenses and tax, okay? All expenses and tax. So the difference between the operating income and the net income is that at the net income, you are introducing the tax. So that is your profits after tax, okay? Your operating income here is the profits right before tax. So we're also going to look at the net income percentage, which is a percentage of the net income. All right, so let's dive into the financial model template. So this is a template, okay? This is just a template. We have different types of templates. You can design your own template. You can make it, you can simplify it. We also have custom templates for different kinds of businesses, okay? So this is a kind of template that you can use to be able to design your own financial model. So this template has been designed for, as you can see, it has been designed month 1, month 2, month 3, month 4, month 5. So it has been designed for 48 months. So 48 months here means 4 years, okay? So after COVID, it's advisable that you do something like 3 years because we don't need to go and start doing long projections. So you can do 3 years if you want to. So you can remove or you can add. Some persons might also want to do 5 years, but it's now recommended that we do maybe 3 to 4 years. That will be fine. All right, so we are going to use a car wash business as a case study. So let's assume that we are starting a car wash business, or we already run a car wash business. So we are starting a car wash business and we want to do a financial projection of what this business will look like, and also consider whether we are going to continue with it to see the profitability and all that. So the financial model can give us the future profitability of this business to see whether it is viable or not. Okay, so you might have an interesting business. So most times when we look at businesses, we look at it from a 3 pillars. We look at it from 3 pillars. Look at it from the desirability aspect. So this is now where you have a product, a service people love, people desire for it, right? Now we also look at it from a feasibility aspect. You might have a great product, a great service that you want to push there into the market, but you don't have what it takes for you to actually build that product, okay? So you are not a doctor, you are not a pharmacist, and you are looking at producing a drug that will cure cancer, that will stop different ailments and diseases. So it might be a great product, but you don't have what it takes, right? That is the aspect of feasibility. So it is not feasible. So you can also look at it from the aspect of you have what it takes, but you don't have enough resource. So it's going to cost you $1 billion. Now you look at it, it is not visible. Like you can't raise that fund, okay? So from what you have done, it is not visible for you to raise $1 million. And what you have, your financial model is showing you that you are not going to get that $1 billion from the whole process at the end of the day. Though people love it, but it is not going to be profitable. It's going to take you years for you to get profitability. So the financial model is going to help you see all those. So let's get started. Today, we are going to use a car wash business as a case study. All right, so let's do this together. If you can't see the screen, you can zoom your screen at every point if you're using a mobile device, or you can use a landscape so you can see. So what I can also do here is to zoom my screen to see. Okay. All right. I think this can work to zoom my screen to see that it will be much bigger. All right, let's get started. As you can see, there are 3 tabs here. The customer acquisition model, we have the monthly model, and we have the income quarterly roll-up. Okay, so these are the 3 tabs that we have. So we are going to start from the customer acquisition model. Like we mentioned, CAC, customer acquisition cost. So this happens to be the sheet where we are going to look at what it costs us to acquire a customer and also our churn rate. So let's do that together. So at row 3, we have advertising spending. So we can call it marketing spending. So this happens to be our advertising spending. So let's assume that our channel for customer acquisition happens to be Facebook ads. So we are saying that every month we are going to run Facebook ads to ask people to come, right, and use our car wash business. So we are paying 30,000. So let for you, you can say we want to pay 50,000 every month, okay? Or we want to spend 20,000 every month. So we want to spend 20,000 every month. So if we are spending 20,000, I can drag it and say for the first 6 months, we want to spend 20,000. But for the next 6 months coming, we want to spend 40,000. We want to increase our marketing budget. So another thing you need to understand about this sheet is that any place or anywhere you have the numbers blue, those are assumptions and you have the right to change it. But any place you have black, those are generated numbers. You don't have to change it, okay? So we are only permitted to change those places that have blue or are blue in color. So we are now saying from the, remember, the 7th month to the 12th month is for the 1 year. So we are spending 40,000. So the second year, which is from month 13, we cannot say we want to spend 50,000. So all of these are assumptions. They are all assumptions left for you to decide, okay? They are all left for you to decide. Any amount you want to put there, it must be realistic, okay? So for this would take us to 24 months, which will be for the second year, okay? So the third year, we can say we want to increase our marketing or advertising spending to, let's say we want to move it to 80,000 every month. So we want to move it to 80,000 every month. And we want to do for the third year will stop at 36, right? Why the fourth year, we want to do 100,000 every month. So every month we want to spend 100,000 to run ads so people can come use our service. So at this point, we can drag it to 48. All right, so we are done with that part. The next assumption here happens to be the paid CAC. Remember, CAC means cost of acquiring a customer. So if we run 20,000 naira ad, how much does it cost us to get one customer? One customer. So let's say after spending all this money, 20,000 this month, how many customers did we get from this channel of advertisement or advertising? So let's assume that it costs us to get one customer, okay? Let's assume that it costs us an average of 500. So let's say it costs us 500. So what it means is that when we run an ad of 20,000 every month, it costs us 500 to get one person. So I think Facebook has something they call it your conversion, okay? So for each conversion, it costs us 500. Now, if you are not using Facebook as your channel, for instance, you are running a different kind of channel where you go and do marketing, you go to the customer, you enter keke, enter transport, all that costs for you to go talk to the customer, come back, the customer tells you come back again tomorrow. If it costs you 1,000 for you to complete a deal on an average for a customer, okay, now let's say you set out 50,000 naira for your marketing for that month, and after you go out, talk to customers, enter transport with that 50,000, all you got out of those all of those activities from the 50,000 happens to be 50. Okay, so what does it mean? So what it means with a simple calculation is that you spent 50,000, okay, and you got 50 people. So what this simply means is that your CAC, cost of acquiring a customer, is 1,000 naira. Can you see it? Okay, so that's, by the way. Let's continue with this. I hope this is clear. So if we have 20,000 spending and we have 500 per each, so what it means is that per month, we are getting 40 people to wash their cars. So the new cars per month here is what? 40. Is it clear? So what we can do is to drag this. So let's say this remains constant, okay? If it remains constant, we can drag it. I wouldn't want you to feel awkward. If you don't understand any aspects, you might need to rewatch, watch again, and also reach out for clarity. Will be available to give you more clarity. Okay, so now what it means is that each month, for month 1, we got how many? 40. Now let's look at our month 7. Let's look at our months. Okay. Our month 7. Okay, so yeah, this is it. So month 7, as you can see, we have 80 cars coming to us. Why? Because we increase our marketing spending. So by default, by increasing our marketing spending, we can get more customers, right? Okay, so you can see that you can now go to an investor and say, we have seen that if we increase our marketing budget or advertising budget from by 100%, which is from 20,000 to 40,000, which is 100%, we are going to double our customers, right? And it is a good one for us. So let us go and raise fund, right? Now, that being said, so this is for this. That being said, so we can drag this to the end to be sure that our formula is correct. All right. So by spending 100,000 and our CAC is still 500, we are going to get 200. So we are going to wash 200 cars, right? So this is an assumption, okay? Now, let's get moving. So our total car washed, so we can call it total order, okay? We can call it total car washed based on the nature of your business. So this is your template. You can alter it and personalize it. Now, another important aspect is the churn rate. You see where we have churn rate. Churn rate. So remember that churn rate happens to be the percentage of people, right, that stop using your service. So at this point, we can say that 0. So this means that nobody stopped using our service. So in month 1, 40%, right, use our service. We got 40 cars, right? In month 2, we got 40 cars. So here, those 40 the 40 we got in month 1, also all of them came back. So making it 80, right? Now we can say that for the nature of our business, 20% of those people or 50% of every person will wash their car, right, will no longer return. So that means our churn rate is 50%. So you can also say we don't have any churn depending on the nature of your business. So if you are running a SaaS product where people pay annually, so for that first year, you are not going to have any churn. So it will be after 1 year, you now see some persons that will not say, oh, I'm not using this service anymore, right? So let's assume people wash their car at your place once every month, okay? So we can now say those that did not return are usually 50%. So we can say 50%. Remember, you can also say the next month is the first 6 months can be 50%. The other one can be, you can assume to say, remember, these are assumptions, okay? You now use it to come up with a financial forecast. So we can say that from this, we can now make it 80% as the case may be, but let's leave it at 50%. So let's assume that 50% of everybody we get from the last, everybody that we get from the last month will not return, okay? So let's assume that. Now, we are done with the customer acquisition model, right? So things to pay attention to happens to be your CAC. So if your CAC costs, if your CAC costs kind of reduces, right? it's going to help you to get more customers. So let's assume that this reduces to 200. Okay. So are you seeing that we are not getting 100 customers? So what this tells you is that if we are able to bring up business model strategies, concepts that can help us to reduce these costs, our customer acquisition costs will increase. This could also be the advertising strategy, how we are running our ad. So we can hire someone who can now, who if we give them 200,000, they will get us more persons. Okay. So even if you reduce it by 400, right, that's a whole lot of money. So additional 10 persons will get into your business. Unlike here, you have 40. And these 10 persons, imagine they pay 10,000 or 5,000 every month. That's a whole lot of money. So by just reducing this number, that is why we say you need to understand your the business of the numbers of your business, right? You need to understand the numbers. So if you understand this, you can begin to deploy strategies to reduce this cost. Okay. So let's keep it back at 500. It's not left for you to design strategies through your marketing team to see how they can reduce this. Now, look at this, which is the churn rate. The churn rate, people already using your service. The reason why your churn rate will continue to increase will be because of your sales team. So, or your product is not good, or your sales team, you are not, your customer service rather, you are not providing excellent customer service, or your product is not cool. So once they try it the first month, they are not coming back. So if you're able to increase or reduce rather, remember your churn rate, you have to reduce it. You don't need a lot of people to be, you don't need high churn. You need to reduce the churn. So let's assume that your churn rate is 20. Are you not seeing that your number of total customers has increased because you are reducing your churn? So you need to know the numbers to increase and the numbers to reduce. Okay. I hope that's clear. So let's keep it at 50. So we are done with this. Let us move to the next tab. So the next tab talks about the monthly model. So the monthly model happens to be where we are going to look at each of the months, our expenses, our revenue, our expenses, and all that. Okay. Now, for you to understand this part, remember we said any place or anywhere you have blue, those numbers happens to be assumptions, so you can change them. But any place you have black, you don't touch it. So as you can see, here is black, you don't touch it. So the upper side happens to be the focus. And if you come down, okay, if you come down, you see where we have assumption. At 50 here, you see where we have assumption. So at assumption, this is now where you have the blue part. So you are to fill those assumptions for this. Okay. Now, once we fill this, the numbers here will now begin to be generated. Okay. The numbers here will be generated by default. Okay. All right. So let's begin. Now, for the first assumption, we have what we call the revenue assumptions. So how do we make money? Okay, so for depending on the nature of your business, you now need to look at how you make money. Let's assume that we make money one through car wash service payments. Okay, so people pay us for each car wash we do for them. Let's assume it's 5,000 naira, as we are making an assumption. So let's assume it is 5,000 naira for premium service. Okay, so 5,000. So we can drag this to the end, as the case may be. So let's also assume that that is not the only way we make money. That after someone we finish washing your car, we sell air freshener to those cars. And let's assume that that air freshener is 500. Okay. So what it means is that we make, remember, this is sales of air freshener. So for each air freshener we sell it at 500. So once we wash your car, we sell this to you. So we can drag this to say this is also how, but if you don't, you can leave it at 0. Okay. You can remove that and then leave only car wash, which is your only source of revenue. Okay. So I just wanted to see that we have two revenue streams. Now, here is a refund. Okay, refund, percentage of new order per revenue. Okay, so here we are saying, in case someone will say, let's say there are people who, your nature of business is that out of 100 people who buy from you, 10% or 5% will always say, I beg, pay me back my money, refund me, I don't need again, take back your product. But car wash, you are likely not to have anything like refund. Okay, you're not going to have refund. Someone finish car wash and then the person say, give me back my money and then take back your car wash. So that's not possible, right? So let's look at discounts. Okay, so the next thing is discount. So you can say, oh, we give 5% discount depending on what you want to do. But you can also say, no, we don't give discount. We give discount around December period. Okay, you can say we give discount around December period, November, December. So we can say we give 10% discount here, and also we give 10% discount here. Okay, that's what we do. So remember, if you do that consistently, means around 23rd, the month 23rd, which is will be another November. Remember that 24 months will be another. So depending on when you are starting, you can also change this as the case may be, month 1 to January, February, March, as the case may be. Okay, so this could be what we have, or you can say we are not giving any discount at all. So we are not giving any discounts at all. So depending on the nature of your business. So we don't want to give any discounts, so we can remove those discounts. So let's keep it at 0. All right, beautiful. Now we are done with this. We are done with the revenue assumption. If you have other streams of revenue, if you understand how to use Excel, you can go and add more row. Okay, you can add another row, and then you also need to capture it up. Okay, but here we just have to have this. So let's go up and look at the revenue here. Okay, so are you saying that we now have the numbers here? So this one, we just need to drag it. Okay, so we need to drag this to make sure that the numbers tally. Okay. So these were dummy numbers that were there initially. Okay, so okay, so I just need to drag this to get to the last month. All right, so let's look at this. So as you can see, this is car wash service payment, 200,000. So remember that we charge how much? We charge, from our assumption, we charge 5,000, but we are not having 200,000. So how do we have 200,000? In our month 1, how many customers did we acquire? In our month 1, we acquired 40. So if we do the calculation, that means 40 times 5,000. So let's just do a small calculation here. So we charge, we had 40 customers in month 1, remember, and we charge 5,000 naira. So you see how we got the 200,000. So that is how we got this 200,000, as the case may be. Okay, so you can see 200,000. All right, so let's remove this. Now our next month we got this. Okay, why 300,000? Because our number of customers here is now 60, as you can see. That is now why our revenue will keep increasing. As you can see, it is increasing. Now, let us see, we have 200,000 month 1, month 2, 300,000. So let us see, let's say we deployed a strategy that reduced our revenue, our churn rates to 25%. Now, look at this. You now see that our revenue here is going to increase. So it was 300, but now we now have 350 because we now have additional customers here increase. Okay, so before it was 50% here. As you can see, it was 60 customers here, but by 25% we have 70 customers. So this will help us actually increase, okay, that our revenue for that month by 50,000. Okay, but let's assume that it is still 50 churn rate. Now, for air freshener, we make 20,000 for this month, okay? For this month, we made 30,000. For this month, we made this. So here, let's say we offer discount, it would have reflected here. So we don't offer any discount. So our total revenue, right? Our revenue after this discount and all this will be 200,000. Okay, sorry, this is not correct. So this should be this plus this rather. So we did not capture this plus this rather, then minus this. Okay. Yes. So as you can see, this will give us 2. So let me drag this to the end to make sure that the numbers are right. So the essence of this is for you to understand the concept of designing and building your own financial model. Okay. Now, this is what we have. So let's assume we say we want to give that discount. So let's say we are giving discount and we say we want to give 10% discount for each person. So what does this mean? This means that we are going to spend how much? 200,000 on discounts. So at the end of the day, our total net revenue after those discounts will be how much? 200,000, right? 240 minus 20 will give us 200. Okay. So, but we don't want to give discount. So if you wish, you can do that depending on the nature of your business. So we are done with the revenue side. Let us go to the assumption. The assumption part for COGS. Remember, we had what we call cost of goods sold. So cost of goods sold happens to be what it costs you in terms of delivering that service, right? What it costs you in delivering that service, in delivering that product, in creating and delivering that product. So in our case, let's assume that the average cost of water supply per car. So for us to wash that car, how much money, how much water do we have to spend? We need to capture it, okay? So let's assume that we spend a total water amount of 500, okay? So imagine we go to a borehole and buy water of 500. That is what we use to wash that car. So we need to capture it here. So we can also say average cost of detergent, right? Of detergent used per car. So this means probably we need to buy Omo, we need to buy area, we need to buy some certain detergent and all that, okay? So for us to wash a car, all those detergents cost us an average of, for instance, we can say it costs us an average of, let's say 300. Let's say 300. Water costs us this. So remember, because of our revenue assumption, we say we sell air freshener after we finish washing for you. Maybe we perfume it and we put air freshener for you, and we say we charge you 500 naira for that, which is a way we make money. So, but for us to also do that for you, cost of that air freshener and also looking at putting some perfume in your car might cost us. Let's assume that, remember, we sell at 500, so let's assume that we get it at 300. Okay, I hope that's right. So let's assume at 300. So after sales support per customer, so let's assume that after someone has finished kind of his car wash, we'll usually call them and say, hey, thank you for coming over, we appreciate, or we send them SMS, as the case may be, depending on, and let's say it costs you. So for us to call you and tell you thank you for coming and send you SMS, let's say it costs us 50 naira. Okay, let's assume it costs us 15 naira. So here we have been able to look at the costs. So depending on the nature of your product, if you sell products, maybe you now need to look at how much does it cost you to, let's say you sell the TV 100,000, but it costs you the cost price for that TV when you purchased it. Let's assume that it is 80,000. Okay, so you also involved in transportation and shipping it, so the shipping is 5,000. So at the end of the day, you need to put all that, okay, so that you can now see that it costs you, everything will cost you 90,000. With your revenue, you now see that your profit there is going to be 10,000 as the case may be. Okay, so that is exactly what we are doing here. Now, let's assume that you have what you call car wash agent fees. So you have people, you don't want to go and hire, recruit people, hire people, employees, and tell them to sit in the office. Anytime a car comes, they wash. At the end of the month, you pay them 30,000. That might not be a good model for you. You cannot say we have agents. So any car you wash, right? Remember, we charge 5,000. Okay, we charge 5,000 for any car you wash. We are saying that we give you, let's assume that you take 20% or 30% of that money. Okay, so let's assume that people pay online. Your service is e-commerce and people pay online. You can call this merchant fee, flutterweight fee, and put 1.5% here, as the case may be. Okay, so in this case, let's assume it's 50% so that we can get this clearer. So let's assume it's 50% here. Okay, now how much do we charge per car wash? 5,000. So let's go up here. Okay, so let's look at what we have. So your revenue, which is car wash, remember your car wash payment, you make how much? 200,000. Now, if you make on 200,000, and let's look at the cost of goods sold. Under cost of goods sold, you have on the 15, you have car wash agent fee, 100,000. Why is it 100,000? Because you pay 50% of every car washed to the agent. So that is why that is a cost on its own, so which is captured here. But here we might say 50% is huge. We don't pay 50%. What we pay you is 25%, because we also have other costs attached to it and we need to make profit. So let's assume we pay them 25%. So all we need to do is to drag this guy to make sure that we save for all of the months till the end of the 48 months. We are going to give a commission of 25% to all our agents for each car washed. Okay, so after sales support, also we drag it to the end, saying that we spend 15 naira. Once you come to us, we send you SMS, we'll call you in the evening for everyone who come to us. So that is a way to increase our, to reduce our churn rates. Okay, so here, air freshener, the cost of air freshener, we also drag it to the end to say we spend 300 naira to produce each air freshener, or to buy those air freshener and all that. So here we say detergent, okay, it costs us 300. So you can say it costs you 200. You understand your business. So remember, we said that financial model helps you have in-depth knowledge about the business. Are you saying it? So you know exactly what it costs you to deliver that service. So you are not just saying it will be this. You have a financial model that is clearly explaining those to you. So we have the water, so it costs us 500. So if it changes, that's fine. Okay, you can remember, you might not drag it to the end. You can say for the first year it can be 500. After the other year, you can keep increasing it as the case may be. All right, so we are done with the cost of goods sold. So let's go and see the implication. Now here is implication. Now for average cost of water supply, what it means is that we are spending 20,000 naira, right, on water, right? We are spending 12,000 naira on detergent. We are spending 12,000 naira on air freshener, right? Remember, we are making 20,000 here, as you can see, for air freshener, right? We are making 20,000, but we are spending how much here? 12,000, meaning we are making a profit only for that, maybe 8,000 naira, which will reflect at the end of the day. Now, after sales support, those 50 naira we are giving out, we spend 2,000 naira. We spend 2,000 naira, right? Servicing, calling, sending SMS for the total number of, remember, how many customers do we have for the first month? We have 40. So for the total 40 customers, it's going to cost us 2,000. For the 60 customers for the second month, it's going to cost us how much? 60 naira. So you now see that if you do the small calculation to confirm, let me just do it quickly here. So it means that we spend 50 naira and we have 60 customers, right? So that will give us a total of, as you can see, 3,000. So that's why we have after sales support of 3,000. So I'm cleaning this. Okay. Now, so the total cost of goods sold, meaning everything it costs us to produce or deliver this service, is 96,000. Okay, 96,000. So let us now look at our gross profit. So our gross profit, as we mentioned, happens to be here, as you can see, minus this. So this will give us how much? 124,000. So our margin is 56%. So you see that an investor will ask you, what's your margin? And you don't know. So with this, you clearly know what your margin will look like. Okay. So as you also go along, as you see, the margin remains static because we are using the same average number, right? So if you are saying in your second year, this will change. In your third year, this will change. You can now see that your margin can go up, go down, as the case may be. Okay. And also we have not also added some other factors to also okay, so no other factor is coming here. Other factors will come under here. So let's move to the next assumption. Okay, so we are done with the cost of goods sold assumptions. Okay, so let us go and look at operating expenses. Operating expenses, the head count. So the head count here means your salary, you paying salary and all that. Now, all you need to do here is to look at who and who work with you. So let's say you have marketers, you have accountants, you have receptionists. So let's assume your marketers, how much do you pay them? So when you come here, all you need to do, you can see this formula here, times 12, meaning in 12 months. So the 0 naira here, we need to remove it and then say, how much are we paying them per month? So let's assume our marketers, we have people who let's say the people who run this ad for us, let's say we are just using online ad, the person we hire that run this ad for us, let's assume we pay the person 30,000 every month. Okay, or let's say we pay the person 20,000 every month, right? 20,000 every month. So what it means is that we are going to pay 240,000 in a year. So let's say we have an accountant, somebody who, we might say we don't have an accountant, we just have one person who do the same accounting and receptionist, or we can say the receptionist person is the person who do customer service, but we have an accountant who receive the money, manage the money. If you want to make payment, you go to the accountant, you make payment, accountant will give you a tally, you now use a tally to go to the car wash people and you now use that to pay. Then if you come to the receptionist will tell you how our service works, our pricing and all that, and you go to the accountant and make payment. So this accountant might not be someone who is chartered accountant, right? So you can say you are paying the person 25,000, right? So it could just be, so all of these are assumptions, remember. Then we also have the receptionist. So you can say you pay the receptionist 25,000 too, as the case may be. So this, if you have other people you are high, you have, so if you have security men, so you can use security men, but let's assume we don't. Okay, so now the next thing we are going to look at, how many persons, how many marketers do you have? So let's assume we have one marketer. How many accountants do you have? Let's assume we have one. How many receptionists? Let's assume we have one. So if there are two, if you have developers, software engineers who work with you, you can add software engineers, include them here, product design people, include the number of people, as the case may be. So here we can say we have one marketer for the first year. Okay, so after the first year, we might say we are going to have another branch, or we want to increase the number of marketers to 2. For instance, as the case may be, all left for us. All of these are assumptions, so remember. So in our second year, we are going to have 2 marketers, okay? Let's assume we are going to have 2 marketers till the end of the 4 years. So let's drag it to the end. Yeah, I hope this is not so boring. Numbers can be boring, but like, I am not a financial analyst, I am not an accountant per se. I am an entrepreneur, okay? I understand the importance of numbers. You cannot run a business without knowing your numbers. That is why I have to become knowledgeable to begin to teach startups and other entrepreneurs how to leverage the financial model to be able to build a sustainable business, okay? All right, so let's assume that we have one accountant to the end, so we don't have multiple accountants as the case may be. So just one accountant. So let's say one accountant. Then who else? So we have receptionist. So let's assume we have one receptionist. So here you can also come to the second year and say, oh, we are going to have another branch. So because we have another branch, you can now say in your second year, maybe in your month 25, your receptionist will change to 2, your accountant will change to 2, your marketing will change to 2, your marketers will change to 2, right? So all of these are assumptions. They are all left for you to decide what are you looking at? What are your projections? Are you looking at having 5 branches by 2 years, by 3 years? You factor all that in. You also factor the number of marketers you have as you are growing, as you are doing that. All of the numbers will now begin to reflect on your financial sheet. Okay. Now, another important thing is the benefit. So you can decide to say, oh, we want to give 10% benefit to all our customers, all our employees, maybe health benefit, as the case may be. So what it means is that if they pay you 100,000, for the person they pay 25,000 or 30,000 for example, you are going to get 10% of that, which is 3,000. So you are going to pay them 33,000. Okay. So this could be benefits in terms of health benefits. It could be insurance, as the case may be. So, which is 10% of your salary. Now, let us go up and look at the results of that. So this is the, okay, so this is the personnel. So we need to update it here. So let us go and look at what we have. So we have marketers, then we have benefits. So let us copy it and update here. So we have this so that it will tally. All right. So look at this. So marketer, you pay 20,000. Remember, you have one. Then accountant, you pay 25. This you pay 25. Okay. So benefit, the total benefit you are going to pay for that month is 7,000, meaning 10% for each of these people. So 10% of 10% of 20,000 is how much? So let's do that. That should be 2,000. All right. So 10% of 25,000 should be 22.5. Sorry, 25,000 should be 2,500. For the other person, 2,500. So let's see the total. So the total is 7,000. So have you seen why the total benefit is 7,000? So we can clear this. So all of these are already here for you. Okay. Now, all right, cool. So the total personnel cost, meaning your salary, and all that, is 77,000. As you can see, 77,000. So it's going to cost you 77,000 to pay every single month. Now let's now look at, let us now go to the next assumption, which happens to be what? The other operating expenses. So the other operating expenses, let's assume we have initial cost. You know, we are setting up this car wash. Maybe we need to buy, let's assume we are digging borehole. Let's assume we are doing different things and all that. So depending on the model. So if we are digging borehole, means that we are no longer going to say we spend, remember there is a point we say we spend. So because I am understanding what I'm doing, I remember that we spend 500 naira for water supply. So meaning that we are not opening any borehole. Probably we are going to a place that already have borehole by the side and we open our own. So if you're going by opening up your borehole to use the water, what it simply means is that you are going to likely maybe put the cost of borehole here, which is initial setup cost. Okay. So let's assume that for the initial setup cost, we need to get an office. We need to get where the accountant and all that will be. We need to get some other things, receipts and all those things, set it up. So let's assume it's going to cost us 200,000, okay, for that first month. For that initial setup, it's going to cost us. Now let's assume people also order or place booking for car wash through our website or portal. So we need to give it to someone to design for us. So let's assume it costs us 80,000 to design using WordPress, as the case may be. Okay, so someone can place order and we can be able to receive it. No complex stuff. So you place order, it takes you to WhatsApp, and then they will now get their they will now get to you. Okay, so just the cost of creating the website could be this, for instance. So let's say you also run some maintenance for, let's say, your generator and all that. You might want to, so we can just capture it in here. So all of that, we can say maintenance. So, maintenance here, you are not doing any maintenance. Okay, so the initial cost here will also be cost of generator and all that. So let's assume it's 500,000. Remember, we are not digging any borehole. So let's assume it's 500,000, as the case may be. So 500,000. So we are not going to be spending it here anymore, right? So the initial cost here is going to be just this. Now the maintenance, we are not going to maintain those generator and all that in the first month, right? Our portal, right? We are not going to keep paying. Now, when you host a website, you need to renew it every year. So in the 13th month, we might need to renew our domain. Let's assume it's 10,000 naira. So we have to renew it. So in the next year, which should be around 25 months, we need to also renew it again. Let's say 10,000 naira, right? So in our 36th month or 37th month, which is for the next year again, we have to renew again. So this is just when we pay for this web portal, because we pay 10,000 to renew it, but the initial money to design it for us was 80,000. I hope you see how we are making assumptions. Now, the maintenance, we are not maintaining anything at this point because we cannot just start maintaining. So we start maintaining, let's assume we are maintaining on the month 13, the second year. Let's assume we have 30,000 naira we budget for maintenance, okay, which we are going to use to do maintenance across. So you can also have things like operational costs, okay, so maintenance and operational costs. So we can call it maintenance and operational costs. Maintenance and operational costs, for instance, okay. So let's assume it's this. So if we're going to go by this, so we can say that every month we are going to be buying fuel and all that. So let us capture it here. At this time now, we cannot decide to capture something here. So we can say every month we buy a fuel of 30,000 naira. So fuel don't cost Nabi. So let's do 40,000. Fuel don't cost. So subsidy don't go. So fuel don't cost. So let's so let's now say we are going to do this. So remember, we do this till the month 12. Okay, so month 12. Now 40,000. Now let's assume that in this every beginning of at the end of the 12 months, remember we pay 40,000 for running of fuel and all those things, operation costs. Now we cannot say we need to do 70,000. Why are we doing 70,000? Because we are going to be doing maintenance of generator, maintenance of equipment, maybe buy new fan or anything. So we can just, at this point, something has spoiled, we can say 80,000 here. At this point, 80,000. So after this 80,000, we still continue our 40,000. Remember, we do 40,000 for the fueling. Okay, so we can drag this till the next 24 months, right? So we do this for the next 24 months. So after here, we also consider the fact that we are going to buy something like maybe a new fan or repair generator again. So those costs, we can factor them here. Remember, we did 80,000, right? So we can also do 80,000 here, or we can now decide to do 100,000 as the case may be. Okay, so we can decide to do 100,000 here. So after this 100,000, maybe our operation here, something has increased. So we can now begin to do 50,000 every month. So we can do this till the end of 36. Okay. Now here, remember what we did the other time. What we are doing is 50,000. The logistics 50,000. So maybe here we can do 120,000, as the case may be. Then we'll now continue our logistics. Let's say our operation cost is now 60,000 every month. So all of these are assumptions for the 4 years. Okay. So we are done with this. Our initial cost is this initial setup cost. Okay. So maybe in our month 2, sorry, in our year 3, which is around 26, maybe we want to set up another branch. If you are considering that, so we cannot initial set up for another branch, we cannot come here and do another 500,000 as the case may be. So this is just an assumption. So, but we are not doing that. All right. So before we check it up, the reflection, we can also look at this other miscellaneous expenses. So let me delete this part, delete this row so that we can bring it up. So we have other miscellaneous OPEX, meaning OPEX is operating expense. So here we just want to capture miscellaneous expenses. So we want to say for every revenue, for every net revenue that we have, we want to take 5% out there as miscellaneous because we might not know what might come. So we can just say 5% here. So this 5% from this model is going to take it from, let's say, our net revenue. So if you watch, okay, don't worry. When we go up, we'll see it. So here we can drag it to the end to say we want to capture 5% as miscellaneous. And this 5% is 5% of our net revenue, right? Net revenue. So we are going to use it as miscellaneous. So let's go up and see other operating expense, the reflection up. Okay. So look at it, other expenses. Okay. So the first thing we have there is the advertising spending. So this advertising spending, remember we captured it here. Look at where we captured it. So this is the 20,000 you said you spend there, 20,000. In your 7th month, remember you said you are going to spend 40,000. So here, what this means is we are tying it to what you are spending there. So if you check the 7th month, you are spending 40,000. So this is the advertising spending, which is part of your other expenses, okay, that was brought here. So the initial setup cost, look at it here. Remember 500,000, then other ones are not there. The car wash web booking portal, remember it's 80,000. Then we are doing domain renewal every month. As you can see, it's being captured here, okay. Then we are doing maintenance costs. So maintenance and operation costs, remember that's what we called it, and operational cost. So remember it's going to cost us 40,000, okay? And we said in our month 13, it goes to 18,000. So all of those are captured here, okay? Then look at where we now say that miscellaneous. Can you see that miscellaneous? So we can also bring it up here as miscellaneous so that it will be clear, so that we can look at it here, other miscellaneous. So we are saying 5%. So let's change this, okay, other expense. So let's say call it the miscellaneous so that we know. So this is 11,000, meaning that this 11,000 is, as you can see the formula here, if you want to check it. So it's saying C8, okay? C8 happens to be, what is C8, which is the net revenue, okay? So it's taking 5% of your C75 is 5%, right? C79 rather, as you can see, C79, look at 79, 5%, as you can see, 5%. So that is 5% of your net revenue. That is what will give us that, that is what gives us this, okay? So this is what we are using to do miscellaneous, just anything might come up. So at the end of the day, our total other expenses, that's total other operating expenses, is 651,000 here, but here it has dropped to 71,000. Remember, it is a cost of initial setup that made this thing to go up, okay? Now we are done with this part. So let us now look at the total OPEX the total OPEX here is now the summation of the personnel costs and the what? The other operational costs. So that will give us a total of this. So this is what we are spending for the first month. This is what we are going to spend for the second month, third month. So let's say we want to raise 500,000. You see already in our month one, we need 728,000 to run this business in that first month, or else we cannot execute, right? So we need to make sure we have up to this amount for us to execute for this month. We need to make sure we have up to 148,000 to execute whatever we have for this particular month, right? And remember what we mentioned, that your financial model helps you to stay within the in your defined business structure, so that you will not wake up one day and now go and start adding additional costs that will increase certain things for you. Now, another thing is it helps you to decide the investment. How much investment are you going to raise and all that? So as you can see, it is costing us this for the second month and all that. So for the first 3 months, if you sum it up, as you can see the total here, under here, it is 1,024,000 naira. So if we need to execute this for the next 3 months, this is what it will cost us. So for the next 1 year, which is 12, it is going to cost us 6.47 million. So if we are looking at having money standby to execute this business, we already know how much we need to raise, right? Now, let us now continue. So the operating income, remember we already mentioned it from when we talked about the key financial metrics. So the operating income, as you can see, okay, happens to be our C18. You can check the formula in case you want to, but once you alter it, you have an issue. So it's C18, which is what? Our gross profit, right? So our gross profit minus our total expense. So that will give us our what? Operating income. So as you can see a minus in front of the naira, meaning that we are losing money. Okay, but here we have made 38,000. Here we made 69,000. Here we made 89,000. So as you can see, you can be able to ascertain. Now look at this now. Are you seeing the operating margin? Here we had minus 275, but here we had 12%. Here we had 18. So your operating margin needs to keep growing. If it's growing, it means you are really doing a good business. Are you seeing it? As you can see, it's growing, right? As you can see, I'm moving up here. Okay, let me do this so you can see it well. As you can see, it's growing, right? So means that, okay, you are doing well. So an investor will just ask you, what's your margin? And that is what you need to clearly explain to really know what your margin are, okay? Now, this is tax. So for us to do this, we need to go to here. This is an assumption. So Nigeria tax is 7.5, okay? Whether it is a VAT. So for every VAT we consider, we factor it in here and all that, because we need to comply with the law. Now, here we have 7.5%. So what we are saying here is that we are factoring it in here, okay? So this is it here, okay? So you only pay tax when you are profitable, when you have profits. So here, as you can see, you are not paying any tax. You are not going to pay any tax. You're not going to pay any tax. So this financial model can now show you that you are going to pay a tax of 18,000 to this, right? So this is what you are going to pay, which is 7.5% of your profit. Okay, now this is what you're going to pay. This is what you're going to pay, as the case may be. So as you can see, as your business is growing, you can see you are going to keep paying a huge amount of a tax. I don't know if this calculation is right. So in case you have one or two errors, you just like ChatGPT, it will tell you you might get an error. So just in case, but let me confirm something. Okay, so I want to see how much are we making. per se for us to even talk about this. So how much is our revenue here? This is 2. So that tax is not correct. I guess as much, but that's by the way. Okay, so this is 2 point. Okay, I doubt that's not correct. I might need to look at it later on and confirm that aspect, because that this amount of money is huge for you to pay as tax. How much are you generating? So I might have to look at that later on. So our net income, like we mentioned, has to do now removing our operating income minus our tax. Okay, so as you can see, these are operating income, these are tax. So the deduction here is still the same thing. So the same thing here until we start generating tax here. So this is where we have tax. So if you do this minus this, it will give us this, as you can see, and you can see the margin has dropped. So the net income margin is a percentage, okay, of the net income. So this is all we have here. Now, how can we know what our monthly burnout rate is? So let's go and look at our total OPEX. These are total OPEX. So this month, this is what our monthly burnout is. So on an average, you can see that after our initial setup, on a monthly basis, we spend 148,000 as the case may be. So at some point, it also increased to 168,000 as it may be. Okay. So let us, because of time, let us now go to the last part. So this last part is just an analysis. It's just a summary. Okay. It's just a summary of all we have done. So, and it's structured in, like this is for the first year, and it's broken in quarter 1, quarter 2, quarter 3, quarter 4. So it helps you to summarize it. So this is 2023. You can also change this one to 2024 as the case may be. You can change this one to 2025. Can change, am I right? We can change this to 2025, and then we can change the last one to 2026. So yes. All right. So let us look at what we have. So for the first quarter, what first quarter means 3 months. So we wash 170 cars. So let's go back and see. So this is the first quarter, meaning the first month, the second month, and the third month. So if you see the sum here, if you look down here, once you highlight the 3 of them, you can see the sum here, which is 170. So this is just a summation that in one quarter, this quarter, you're going to wash 170 cars. For the second quarter, you wash this. For the third quarter, for the fourth quarter. So you need to keep increasing this based on your marketing and budget. So the total number of cars you wash for this year is 829 cars, right? And the total revenue you made is this amount. So this is based on the total, what's it called now? The total amount that you charge. Okay, so this is your gross revenue. So your gross revenue here now is now a summation of what you charge, the 5,000 naira you charge per car, and also the 500 naira you make per perfume. Remember, we say car perfume. So that makes it 5,500. Okay, so let's do a simple calculation to be sure we don't have a mathematical error. So what it means is that we are charging 5,500. Okay, and we washed 800 and something cars. So let's see. So I think there's an error somewhere. So this should be what it should have been. Let's confirm what that is. Let me reduce this. So this should have been 4.5 million, right? As the case may be. So probably there's an error somewhere. So let me see if the summation of this is working. Let me be sure that this is summing rightly. Yes, it's summing rightly. Okay, so let us also be sure. Okay, this is a gross revenue. This is a gross revenue. Okay. This is the net. Oh, sorry. I think this is it. So this is our gross revenue. So let's confirm what this is. This is a summation of this and this. This is our net revenue. Okay, so this is C8E8. So let's confirm that our net revenue, let's confirm that our net revenue C8. So these are net revenue. Okay, why? Okay, these are net revenue, which is this. Okay, so let's do the summation here for the first 3 quarters. So as you can see, for the first quarter here, this should have given us 935,000. So let's confirm that for the first. Okay, so this is it. Okay, so oh, okay. So see what happened here. This is the monthly. Okay, so you see where we got it wrong. Wrong. So this is the monthly. Okay. Are you do you understand? This should have been quarter. So this 220 here is for this month, for the growth, for this. So this should have been, so if we are going to redo that, so this should have been a summation of this plus this plus this for the 3 months, for instance. Okay, so did I get it right? I don't think I got it right. So because of, let me redo it. So this should have been this plus, okay, this, which is this, plus this, plus this, okay. So this is what it should have been, okay. Right, remember that our gross is now a summation of the car wash and this, okay. So the completion of the other month, which is this plus this. So this should be right, okay. Okay, so this should be right. So as you can see, are you seeing it here? So we have how much? 3935. Why 935? Okay, so what I can do is I might need to drag this to see if this will just so it did not tally. No, it did not tally. So I would need to do that for this and this, but this is correct. Okay, this is correct. So let's, okay, so we can, let me just remove this guy and we can bring it back later. So let me remove this guy. Let me just hide it or remove it. Okay, so now we'll need to go and change the formula there. Now, the net revenue here, this is our net revenue. So this is the total amount of money we are going to generate at the end of the day. Okay, so this is how much we are going to generate at the end of the day. All right. So, and I hope this is correct. Okay, so but you understand the concept. You understand the concept. All you now need to be sure is that what letter we are going to look and make sure that all the formulas are correct. So once you enter your assumptions, you just have your exact. So the cost of goods sold, remember we have the cost of goods sold. So this is what it costs you. This is what it costs you quarterly. So you can look at the first quarter. This is what you are going to generate the first quarter. So this is the total money you are going to generate, okay, in a year, as you can see, gross profit, okay. This is your gross profit. You have not included the personnel. So this is how much you are going to pay per quarter, this personnel salary. So this is what you're going to pay. This is what you're going to pay. So in 1 year, this is how much. So you can know and say that salary is going to cost us 924,000. So you know what you are doing. You know what you're saying. So you are telling your investors, this is how much we are going to. We need 3 million. We need 5 million. 924,000 or 15% or 40% will go into salary because this financial model has been able to help you do that, right? Okay, so other expense, rather, you remember other expense, which is what we have here, which is OPEX. remember we have OPEX other expense. Look at it here. Okay, so yeah, look at it here. This is other expense. Remember we have other expense. We have this is other expense and this is personnel. So the two of them will give us the total. So we also broke it down so that we can know what the other expenses are. So remember that the first month, the money here is huge, the 500 initial cost. Why here it has reduced, as the case may be. So this is how much we are going to spend. So in a year, remember this is how much we are going to spend in a total in a year. Okay, as you can see. So if you want to do it in a monthly model, remember this is a monthly model. We are spending 2.356. So in a monthly model, your total OPEX, which is this. So we can say in a year, that one is 2.3. So we can just cross check. So this is 2.4. So some we have a little addition somewhere. So probably, so I just wanted to be sure that I'm doing this so that we understand the concept of the financial model. So anywhere you have maybe a deduction, you know that it is from the what's it called? It is from the formula. Okay. So like I said, this was we have the one that does not have any error that has been checked. So I just use this. Okay, so let's look at the first 3 months for this. So this is 231. So this is correct. So let's look at the first 12 months. This will give us 924. So let's look at operating, so which is 924. So this is correct. So let's look at this guy, other expense. So other expense here is giving us for the first quarter 9793. So I'm just doing a cross check. So other expense. So this is other expense for the first quarter, other expense, as you can see. So it's giving us, this is giving us how much? 793. So let's see what this is giving us. 793. Okay, so that is correct. So for the next 3 months, this will give us, as you can see, this is giving us 213. So this is giving us how much? 213. Okay, so we need to be sure where the error is coming from, just in case you also want to do the cross-checking even when we have corrected the formula. So this is 273. So the next one is 2. So you can see this is not correct. So this is 273, as you can see. So you see where this is not correct. So this should have been 273. So let's, if I want to correct this, so I can quickly look at this, and then this is from month 25. So let me go here. This is from month. Are we correct? Are we really in order? That should be from month. Okay, that should be from month rather. It should be the first 3 has gone. The first 3, that should be from 7, if I'm not mistaken. That should be from 7. So other expense. So we do 1, 2, 2, 3. Okay, so which will give us, so you see the correct stuff here, 273. Okay, 273. So let's look at it here, which is 273. So let's look at the last 3 months. 1, 2, 3. So this will give us 2732. So this should give us 273. So let me drag this and see whether this will correct it. No, it did not. So let me take it back. So here, all we need to do is now look at the last month, which is a summation of all of them. So I can just do this, which is from month 10, right, plus month 11 plus month 12, which will give us the last 3 quarters. So that will give us 273. So which is a total of this. So we have 2476, which is our total OPEX. So if we go back here, I'm just trying to show you that in case there are errors, just understand the we'll get the template without any error. Okay, so as you can see, we have our total OPEX. Sorry, this is total here. So our total OPEX for the 12 months, as you can see, is 2476. So if we check here, It is 2476. So it is not correct, right? So this is our operating income. This is the margin, as you can see, as we have explained in the monthly aspect. This is the tax. You also see the place we are charging tax. So remember, we also check the concept of the tax and see where what is not right. Okay, so we check the concept of the tax and see where we are having any issues. Okay, so tax can have decimals, so let's leave it at decimals. All right, cool. So the net income, we have already done it in the monthly aspect. Okay, so it just, as you can see, is what B18, which is your operating income minus your tax, right? Remember, your net income is your revenue or profit after tax, right? Kind of profit after tax. Why this guy here, as you can see here, it is your B10, which is your profit, your gross profit, and minus your total operating expenses. That will give us our operating income. So this simply means that this is the total money we have, the cash we have. Okay, but here we are losing money. So here you see it has gone to plus, so we are making profit here. So at the end of the first year, you see that we are going to make how much? Okay, so you can see, so we can make this not being bold. So let me now make it bold. So here, as you can see, the total, we are going to make a profit, or the cash we are going to have at hand is going to be this, right? Okay, but before, let's come back to the cash rather. So this is the money flow that we are going to have. Okay, the flow of money we have. Okay, but now let's look at the last thing as we summarize. This is a cash investment, the cash investment. So let's assume we raised 2 million for this business. So let's assume we raise we did not raise any money at all. As you can see, if we did not raise any money, we can't run this business, because as you can see, you see the operating income. So this is how much we need to operate this business. Okay, so we done. So if we need to run this business, we can say let's raise 500,000. So if we raise 500,000, this is just an assumption. This is a cash investment. So if we raise 500,000, the cash balance here is going to be 3,000 naira. As you can see, at the end of this month, after we finish up this is the money, the cash balance we are going to have at the end of the day. So because we are generating revenue, you see what we are going to have. Okay, so if we are going to invest, we are raising more money here. Okay, so let's say we are raising 1 million. So you can see we can have more money here going. So this is now when we can see how much money we might need. Okay, this is how much money we might need to have. Okay, at the end of the day. So, but let's reduce the cost of the car wash. So let's say the car wash business is 3,000. So remember, this is an assumption. We are rounding up. So this is an assumption. So let's assume that the car wash business is 3,000 naira. So in this case, this is 3,000 naira, for instance, so not 5,000. So in this case, you see that our revenue is going to drop, because the price now, our revenue is going to drop because of the price of our car wash has reduced. So let's go back here. I want to show something. So here, let's take it back to 500,000. Okay, so let's take it back to 500,000. So can you see that when it was 5,000 naira, at this point, we were able to execute the business and make and have a cash balance of 3,000, right? But here, because the money we are not generating, the revenue has dropped, because we are not charging 3,000, no longer 5,000. Are you seeing it? So that is now why if we raise 500,000, we cannot be able to execute this business here. So what is this is the amount of money we need for this particular quarter. So this is for the quarter, right? This amount of money we need, 740. So if we are raising 1 million, for instance, here, if we raise 1 million naira and say that's what we are using to start based on the model we have. So what it means is that we are going to have this money left. Are you with me? We are going to have this money left. So depending on the nature of your business, you might be able to raise 10 million, and the 10 million you have raised, you are still not making profits. right? You'll be running minus, minus. Then at some point, because your revenue has started growing, okay? So let's also try something while we summarize. So let's say in our first year, okay? Let's say in our first year, we are not going to make money in our first year. Now, this is not in a situation for the car wash business. Are you with me? So, but in a car wash business, we need to start making money. But in an app kind of business, you might not be making money immediately at some point. So our first year, we are not making any money. So if you come here, you will see that at this point, you see how much money we are losing. Are you seeing it? Are you seeing it? So this is how much money, and at some point, probably, can you see now? Can you now see when we start covering back that money? Are you seeing it? This is not minus, but at this point, we are still running minus 126, minus 7, 4, minus 1 point. Why? Because we are not making money. There was no money that we are making at that point. So we can keep losing money. Then this is now when, from your financial model, you can now say, in our, as you can see, this is now when we are breaking even. So we can go up and see, this is 2025 quarter 2. So you can know the month when you can now break even. So with this, your financial model can now help you. So let me turn this back to, let's turn it back to this. Okay, so let's assume we are raising 1 million. So we are done, guys. So you see, your financial model helps you use numbers to tell story. So if you are going to pitch investors, you can go to them and say, good morning, everyone. I am here today to raise $5 million. I'm here today to raise 5 million naira. I'm here to raise 1 million naira. We want to use this money mainly for packaging. If we use this money, if we invest this money in packaging, currently we spend 200 naira on packaging. This money will help us buy in bulk, and it will drop the cost to 100 naira by 100% reduction at 100 naira. And this will increase our revenue by over 200%, helping us generate more money. But currently, we don't have enough capital for us to buy this packaging in bulk that will help us reduce the cost of packaging and then increase our revenue by so. And we can repay you in the next 3 months because you already know your financials, right? You can also tell a story to say, it costs us an average of, so you can go to this, it costs us an average of 500 to acquire one customer. If we're going to invest more money in marketing, in advertisement, it is going to cost us lesser, right? Or it's going to help, we want to scale, right? If we invest additional, for instance, if we invest, we want to raise 1 million and we want to use 500,000 for our marketing. So let's do 500,000 divided by 12, for instance. Okay. So let's say we are raising 2 million and we are using 1 million for marketing, for instance. So this should be 1 million divided by 12, if I'm not mistaken. So this is about 83,000 naira. So let's assume we are now pitching and we say we are raising 1 million and we are using that 1 million for marketing. So this means we are putting 83,000 naira here for, so we cannot say that this will help us increase our customer acquisition by so percent, which is a total of 167. Okay, so if we push this, for instance, I'll turn it back to what we have before or earlier. So if we do this for the 12 months, so we can easily say, as you can see, we can easily say when we go to the summary here, okay, so we can easily say that we have a total of 3,400. So we want to invest in marketing, because if we invest in marketing to put in 80 something thousand, this will increase. So you see, because you really understand your numbers, you can clearly know why you need investment, right? Have you seen why the financial model is very, very important? So thank you, ladies and gentlemen. If you have any question, you can contact us. You can reach out to us. So Remember my WhatsApp contact. I will drop my WhatsApp contact. So it's 080 68284913. So if you have any clarity why you are building your own model, you can reach out to us at Rad5 Tech Hub. You can send me a WhatsApp and inform me about this, and we can look at supporting you for you to complete your financial model. Okay, so remember we say we have different templates for different services for depending on the nature of your business, right? So we have different models, we have different templates. Okay, so you're also free to look at other templates that might work for you, as the case may be. All right, so thank you, and do have a wonderful day ahead.